Do you want to learn how to mitigate or reduce your tax impact on your retirement plan? Well, my name is Joe Bogan. I'm a certified financial planner at Parkmount Financial. We help people plan for their retirement and get through retirement with income planning. We're going to be talking about a lot of our clients that come to us with a pretty significant retirement account balance. And the reality is, if they have $1 million, sometimes $2 million, sometimes more in that retirement account, a good 20%, possibly maybe even more, is owed to the government in the form of taxes. And so this just illustrates the immense impact taxes have on your retirement plan. And with some thoughts and some planning, it is possible to mitigate the impact of those taxes, maybe even significantly. So before we get started with these, just remember, everyone's situation is very unique and context specific. These are broad ideas that we think could have value, but the value is very dependent on each individual's circumstances. The first big idea is strategic awareness. You have to know how much taxable income you're going to have if you did nothing. Basically projecting out all your income sources, whether it's pensions, social securities, annuities, whatever it is. What is your baseline income? How much income do you need? And what are the sources of income that are available to you? Each of these sources are going to have critical tax consequences. And so when you have a plan that is driven by the awareness of how much you need, where you're at as far as an income generation standpoint, you can analyze where you're at on the tax brackets. Where is the next highest tax bracket? And could you strategically pull from different sources that have lesser tax impact if you need to reduce your tax impact, or if it's more strategic for you in the big picture over a number of decades to accelerate taxes. And so having a strategic awareness of where your taxes are today and where you're likely to be over the future is critical to developing a smart tax plan that mitigates taxes over the life of your retirement. The second big idea with tax planning is strategically using Roth. Whether you're preparing for retirement or you're in retirement, understanding the importance of a Roth account is critical. The benefits of a Roth account are basically that it's tax-free growth and tax-free distribution. So that money goes in, it's already been taxed. When it comes out, it could grow and grow and grow. It's completely tax-free and doesn't impact your tax brackets at all. So when to get that money in that Roth and take those taxes to get it in that account involves an analysis of how your taxable income shapes up in any given year. If you have low taxable income relative to your lifetime expected tax rates, you want to be accelerating Roth conversions. That could be early in your career, or if you're in a career transition with low income in 1 year, or when you're in retirement, it could mean that you want to accelerate taxes into Roth accounts early on in your retirement to mitigate the huge RMDs that might impact you later on down the road. These are all examples. It is a very unique situation, though. There are ways that this can go wrong. For example, if you're taking Social Security, it's not fully taxed, and you're then accelerating your taxable income with Roth conversions, that can trigger extra taxes on your Social Security, which can be prohibitive. So you have to be on the lookout for any of the pitfalls that may go with accelerating Roth conversions. And having a plan, you evaluate the rules, evaluate your situation, and make decisions on where you should be taking advantage of these Roth accounts. The third big idea is understanding asset location. So different investment types have different tax consequences. If you have bonds, they're going to be taxed at taxable income rates, which could be higher than other investment income rates, such as long-term capital gains. Usually that's lower than your income rate. Same with qualified dividends. Usually that's a lower tax rate. And so strategically locating these different types of assets with different tax rates in the appropriate account can drive potentially a significant tax savings. So for example, you're probably going to want to have fixed income, whether that's money markets or bonds. If you more heavily weight that in your retirement accounts, which are tax deferred, you're going to get a much more tax efficient outcome from these types of assets that cause higher income taxes. And likewise, for investment types that are likely to produce capital gains, putting those outside your retirement account, balancing your portfolio on a high level, but also taking advantage of those lower income tax rates for those specific types of investments. So I hope you found this video helpful. These are just a couple of ideas that we often run by people and work with people to implement to drive more tax efficiency in their planning. There are several other ideas that we won't be covering today. If you found this video helpful, please subscribe to our channel for more financial planning adventures. If you're planning for retirement and you want to talk with a financial planner, go to www.parkmountfinancial.com. There's a place where you can contact us there. You can also put your information to get a copy of our client newsletter if you just want to stay in touch for when you might want to possibly contact us later on down the road. That's certainly an option. I hope you found this video helpful, and until next time,